The Asian financial crisis of 1997 did not begin as a collapse, but as a whisper of doubt moving faster than policymakers could hear it. When I return to that moment, I do not start with panicked markets or collapsing currencies, but with confidence, too much of it concentrated and unquestioned. For years, East and Southeast Asia had been celebrated as miracles. Thailand, South Korea, Indonesia, Malaysia, and others were praised for rapid growth, export-driven success, disciplined labor, and seemingly unshakable stability. Capital flowed in not cautiously, but eagerly drawn by high returns, and reassured by the belief that governments would never allow failure. This belief, more than any technical imbalance, laid the groundwork for contagion. The foundations of the boom were not imaginary. These economies had grown rapidly through industrialization, infrastructure, investment, and integration into global trade. Exchange rates were often pegged to the US dollar, providing predictability that encouraged foreign lending. Banks borrowed short-term in dollars and lent long-term in local currencies, funding real estate factories and ambitious conglomerates. As long as growth continued and currencies held, the system appeared stable. But beneath the surface, risk was accumulating quietly. Debt mismatches widened, asset prices inflated, transparency lagged behind scale. The miracle rested on continuous confidence. Thailand was where the illusion first cracked. By the mid-1990s, signs of strain were visible to those willing to look closely. The property market was overheated. Export growth slowed as global competition intensified. Yet capital kept flowing and chasing momentum rather than fundamentals. When speculators began to question whether the Thai baht could remain pegged to the dollar, pressure mounted quickly. Defending the peg drained reserves. On July 13, 1997, Thailand abandoned it. The baht collapsed, and with it collapsed the assumption that Asian governments could always protect investors from loss. Contagion followed not because economies were identical, but because investors treated them as interchangeable. This is a recurring pattern in financial history. When confidence breaks, nuance disappears. Currencies across the region came under attack. Capital fled en masse. Exchange rates plunged. Dollar-denominated debts exploded in local currency terms, turning balance sheet weakness into insolvency overnight. What had been a liquidity problem became a solvency crisis. Banks failed. Corporations defaulted. Growth reversed violently. Indonesia's collapse revealed the crisis's social and political depth. Currency depreciation fueled inflation. Food prices surged. Poverty spiked. The economic shock undermined legitimacy of the Suharto regime, contributing to its fall in 1998. Here, history offers one of its harshest lessons. Financial crises are never merely financial. They test political systems, social cohesion, and the implicit contract between state and citizen. When savings evaporate and jobs disappear, faith erodes quickly. South Korea's experience showed another dimension. Despite a sophisticated industrial base, Korean conglomerates were heavily leveraged and dependent on short-term foreign credit. When that credit froze, even global champions teetered. The country was forced to seek an IMF bailout in late 1997, an event that shocked national pride. The crisis exposed how integration into global finance could overwhelm even advanced economies when capital reverses suddenly. The role of international institutions became central and controversial. IMF rescue packages provided liquidity, but at the cost of stringent conditions, fiscal austerity, high interest rates, structural reforms, and rapid financial liberalization. Supporters argued these measures restored confidence and discipline. Critics argued they deepened recessions, worsened unemployment, and treated fundamentally different economies with a one-size-fits-all prescription. The debate still echoes today because it touches a deeper question in a crisis. whose stability matters. First markets or societies. Recovery, when it came, did not follow a single path. Some countries complied fully with IMF programs. Others resisted parts of the orthodoxy. Malaysia famously imposed capital controls, temporarily trapping funds to stabilize its currency and economy. At the time, this move was widely criticized. In hindsight, it appeared less heretical. Malaysia recovered without the prolonged contraction seen elsewhere, forcing a re-examination of crisis management dogma. History rarely vindicates absolute positions. It rewards adaptability. Across the region, painful adjustments followed. Banks were recapitalized or closed. Corporate governance was reformed. Exchange rates were allowed to float. Foreign reserves were rebuilt aggressively. Perhaps most importantly, policymakers learned never again to rely blindly on foreign capital. The accumulation of vast currency reserves in Asia in the years that followed was not an accident of mercantilism. It was trauma encoded into policy. Self-insurance became a priority, even at the cost of global imbalances. The Asian financial crisis reshaped how the world understood contagion. It demonstrated that in a globalized financial system, fear can travel faster than data, and capital can flee faster than institutions can respond. It exposed the danger of mismatched currencies, opaque banking systems, and moral hazard created by implicit guarantees. It also revealed the limits of existing global safety nets and the uneven burden of adjustment placed on crisis countries. Yet the crisis was not only a story of collapse, it was also a story of resilience. Within a few years, many affected economies returned to growth. Some emerged stronger, with more flexible exchange rates, healthier banks, and deeper domestic capital markets. The experience left scars, but also memory. And in financial history, memory is a form of capital. As we look back, the Asian financial crisis stands as a warning written in currency charts and human lives alike. It reminds us that rapid growth, financed by volatile capital, carries hidden costs, that confidence is a resource that can vanish suddenly, and that recovery depends not just on restoring markets, but on restoring trust between institutions and people. And it is precisely here, at the point where contagion gives way to adaptation. And recovery reveals the long shadow of crisis, that the deeper meaning of 1997 begins to emerge as more than a regional accident, but as a global lesson about how modern finance behaves under stress and what societies must decide when stability collides with sovereignty and the next cycle begins to turn toward pressure. And it is in that aftermath that the Asian financial crisis reveals its most enduring lessons. Recovery did not come from a simple return of foreign capital or the restoration of old pegs. It came from a fundamental rethinking of vulnerability. Governments across Asia internalized a hard truth in a world of mobile capital. Stability cannot rely solely on market goodwill. It must be engineered, defended, and when necessary, insulated. This realization reshaped regional economic strategy for decades. One of the most visible outcomes was the aggressive accumulation of foreign exchange reserves. Countries that had once depended on external lenders resolved never again to face a crisis without ammunition. Central banks built war chests large enough to deter speculation and reassure markets. To outside observers, this looked like excess thrift or mercantilist distortion. To those who lived through 1997, it was survival logic. Reserves were not idle assets. They were insurance policies against humiliation and loss of sovereignty. The memory of IMF conditionality of policy, dictated under duress, lingered deeply. Financial systems also changed from within. Banking regulation tightened. Currency mismatches were reduced. Corporate leverage was scrutinized more closely. Exchange rates became more flexible, allowing pressure to be absorbed gradually rather than catastrophically. Domestic capital markets were deepened to reduce reliance on short-term foreign borrowing. None of these reforms eliminated risk, but they altered how shocks would propagate. Fragility was not removed. It was redistributed, and in some cases better understood. Perhaps the most profound legacy of 1997 was psychological. The crisis shattered the myth that rapid growth guaranteed stability or that integration into global finance was an unqualified good. Asian policymakers became more skeptical, more cautious, and more strategic. This skepticism influenced responses to later crises. During the global financial crisis of 2008, many Asian economies weathered the storm better than expected, buffered by reserves, flexible currencies, and hard-earned restraint. The contrast was striking. Regions once seen as fragile appeared resilient, while the supposed centers of financial sophistication unraveled. The crisis also altered the global conversation about crisis management. Malaysia's use of capital controls, once dismissed as heresy, entered mainstream debate. The IMF itself evolved, acknowledging that capital flow management could be appropriate under certain conditions. Orthodoxy softened. History had intervened, reminding institutions that models are provisional and that context matters. The Asian financial crisis did not overthrow global financial doctrine, but it cracked its certainty. And yet the story is not one of simple redemption. The same defensive strategies that protected Asia also contributed to new global imbalances. Large reserve accumulation fed into surplus recycling, influencing interest rates and capital flows worldwide. Trauma-driven policy in one region reshaped outcomes elsewhere. This is another recurring lesson of financial history. Recovery choices are never isolated. They echo through the system, creating new tensions even as they resolve old ones. At a deeper level, 1997 reaffirmed something timeless about finance itself. Markets are not patient. Confidence is not rational. Capital does not wait for explanations. When trust breaks, it breaks everywhere at once, and when it returns, it does so unevenly. The Asian financial crisis exposed how quickly modern economies could be pushed from celebration to collapse, and how recovery depends less on restoring numbers than on rebuilding credibility, legitimacy, and institutional memory. For investors, policymakers, and citizens, the crisis offers a sobering framework. Rapid growth financed externally always carries hidden risk. Fixed promises in a volatile world invite attack. And sovereignty in economic policy is most constrained, not in calm, but in panic. The real choice is not between openness and control, but between naive openness and managed exposure. As new cycles of capital expansion and contraction unfold, the events of 1997 remain quietly relevant. They remind us that contagion is not a flaw of Asian markets or emerging economies. It is a feature of global finance itself. Recovery, when it comes, is never a return to innocence, but a recalibration shaped by memory. Those who remember last time are never positioned the same way next time. If this journey through the Asian financial crisis has deepened your understanding of how confidence, capital, and policy interact under stress, I invite you to subscribe and continue exploring these financial histories with me, and to leave a comment sharing which lesson from 1997 you believe today's global system is most at risk of forgetting. Because history shows that crises do not repeat in form, but they repeat in logic. And it is the logic that determines who survives the next turn of the cycle.